Hello and welcome to Principles of Accounting, Chapter 11. In Chapter 10, we talked about liabilities, and in Chapter 11, we'll be moving to the equity section of the company. So we're going to be talking about stock and stockholders' equity. So stockholders' equity, as you already know, comes from two primary sources. One is when original shares are sold, and the other is our accumulated earnings in our retained earnings section, where we place our net income less dividends and other adjustments. We'll talk about other adjustments to net income in a little bit. So corporations are owned by stockholders or shareholders. Some corporations only have one or two, and other corporations can have millions of stockholders. So it's a form of business that's recognized as a separate legal entity, and the shareholders have rights and responsibilities outside of the organization. The organization is the owners are not responsible for the financial part of the organization as they are in a sole proprietorship or a partnership. So I know we've discussed those, but not since Chapter 1, so it's been a little bit. So in a sole proprietorship and a partnership, the individual owner or owners are liable for the corporation or for the organization. So if the business were to be sued or anything, the owners are personally liable. So in a corporation, one of the advantages is that the owners are not personally liable for anything that the corporation does. So all of these are characteristics of a corporation. The assets and liabilities belong to the corporation, not to the stockholders. They have to pay income taxes on their earnings. They have status as a person in court. They can enter into contracts. The corporation can be sued. They have many of the rights and responsibilities of an individual person. There's actually a decent documentary called The Corporation that's free to watch. There is a little bit of negativity in it, but otherwise it's a little one-sided in its negativity, but otherwise they just have a lot of really good historical information about how a corporation gained legal standing as a person or an individual. So the main advantages are that the stockholders are not personally liable for the debts of a corporation, which is great because if a corporation gets sued, you don't want to have to pay the bill for whatever that could happen if you're a shareholder. So another advantage is the easy transferability of ownership. So this is when we transfer shares of stock from one owner to another, or when we trade stocks on the stock market. The stockholders own a corporation, but they're not involved in the daily management of the corporation. They can elect a board of directors, and that board of directors hires managers to run the business. So every year, stockholders can vote on the board whether they want to retain the board or replace members of the board of directors. And that board of directors is essentially in charge of protecting the company and making sure it has good managers on behalf of the stockholders. Additionally, we have this continuity of existence advantage. So this is when we change stockholders. We don't directly affect the management or the daily operations of the corporation. So if I have stock in a company and I decide to sell that stock, I don't do anything to disrupt the management or the daily operations. However, in a sole proprietorship, if I owned a sole proprietorship and somebody else purchased that sole proprietorship, there could be major disruption or changes in the way that things were done because the individual that owns that company now wants to do different things with it. In a corporation, the daily management is outside of the stockholders' involvement. Disadvantages: corporations have heavy tax. They're also subject to what is called double taxation. So they have to pay income taxes on its earnings, and then stockholders have to pay income taxes on dividend receivings. You also have to pay, so if I own stock and I sell that stock for more, not only do I have to pay income taxes on anything that I earn in dividends, I also have to pay taxes on anything that I sell that stock for over what I paid for it. So if I purchase stock for $5 that is now worth $10 and I sell it, I have to pay a capital gains tax as a stock owner on that $5 that I earned. Corporations are also under a lot of heavy regulation. So this has an advantage to our stockholders, but it is a disadvantage to the corporation. Some of those regulations are very expensive to follow and take a lot of time and management by the corporation to do so. It can be, so you can form a corporation, you need the services of an attorney. Not only do you need the services of an attorney in order to just legally incorporate a business, you also have to pay fees outside of legal fees. You have to, many states have a fee required for incorporating. So corporations will decide on what state they're going to incorporate in based on what the state's fees are and requirements for formation of a corporation. Then if a corporation decides to sell stock, that has additional legal requirements and fees. Another disadvantage is that one of the things that's also an advantage. So that's that separation of ownership and management. So this is when the stockholders and the people who are running the company, so the managers that have been hired by the board of directors, don't agree with each other. And so then the stockholders will form to try to remove the current management of the company. So why do businesses incorporate? Well, the two main reasons are that limited liability, where I don't have personal liability, and the ease of transferability of ownership, with the ability to sell stock. Publicly owned corporations. So these are corporations that have capital stock that is bought and sold through the Securities Exchange. Securities exchanges are like the New York Stock Exchange, where we can buy and sell stock. Corporations can exist without selling stock. So it's publicly owned corporations are ones that do sell stock to the outside or to the public. So they have to, as we know, public corporations have to follow a lot of accounting rules that are set up and managed by FASB, US GAAP, and the SEC. So they have to issue quarterly and annual financial statements. They have to follow US GAAP. These statements are required to be published publicly, so anyone can see them. Most of them are published on these corporations' websites. They maintain websites where people can go see their information. The SEC also publishes them, and other websites will release the information, such as Yahoo Finance, and any other financial website will give you access to that information also. They have to have their annual financial statements audited by an independent firm. What the independence means is that if they hire a firm to do their accounting and to prepare their financial statements in conformity with GAAP, they can't use that same firm to audit those financial statements. So they have to have a separate accounting firm do their audits. They have to comply with federal security laws, and they have to submit financial information to the SEC regularly for review. In order to form a corporation, you choose a state, then and wherever you incorporate is not necessarily where your corporation does business. So a corporate entity can choose to incorporate in any of the 50 states. It's usually selected because they have lenient laws, they have lower taxes required of corporations. Some states have benefits to corporations that move in. For example, the state of Iowa often gives corporations tax-exempt status for several years, so they don't have to pay state income taxes during those years if they bring their corporation and jobs into the state. When we're forming a corporation, we need to submit our articles of incorporation. Articles of incorporation are legal documents that state what the purpose of the corporation is, how we are going to elect our board of directors, what the bylaws are for our corporation's activities, whether or not we're going to sell stock, how we're going to make decisions about what our board of directors positions are. For example, are we going to say that they have 3-year terms and every 3 years we're going to replace members? All of that information is included in the Articles of Corporation. These are a legal document that state what the corporation can and cannot do within their business consignments. There are costs to forming a corporation. Costs such as attorney fees, incorporation fees paid to the state, and other things that they need to do to bring the corporation into existence. So those organization costs become an intangible asset that benefits the corporation over its entire life. Most corporations just expense these costs immediately. They can be spread over a 5-year period for income tax purposes, however. So that's where we might create an intangible asset that has a 5-year life in order to use that 5-year period for income tax benefits for organizational costs.